Hey everyone, Rob B here with Rob D, and you are listening to the Property Podcast Market Update Special. Each month we bring you the latest news from the world of property and beyond. We'll be looking at the property boom to see if it's still happening. We'll be looking at the best places to invest, the rental boom, which absolutely is still happening, and bring you a really interesting story on build to rent, all of that, plus so much more in this week's episode.
Welcome to the Property Podcast. Thank you for joining us once again, where every Thursday we take time out from our day job of advising a multi-million pound property fund and share the lessons that we've learned along the way for free. So many big news stories to get into this week, but just before we do, now is the time to make sure that you are following the show on your favourite podcasting app. So on Apple Podcasts, hit the little plus button. On Spotify, you can hit the follow button. Make sure that you do get every episode downloaded to your device automatically for free, so then you won't be missing out on any more important episodes like this one.
So much to cover this month, so many news stories to dig into, but before we do, we found possibly the best deal in property available, and you can all take advantage of it. And Rob, that is the Property Hub magazine.
Well, yes, it's a great deal, and it just keeps getting better, because when you subscribe, you get the physical paper copy through your letterbox 6 times a year, but you also get instant digital access to every back issue we've ever done, and there's now 35 of them. So immediately after subscribing, while you wait for the next issue to drop through your letterbox, you can go and work your way through. And it's not the case that, oh, well, one from a few years ago isn't relevant anymore, because there's always our location focus feature where we profile a different city in the UK. So even if it's not a magazine from the last year, say, chances are that'll be very useful for you if you're in research mode. And you'll also be able to look at the most recent issue where the cover story was about buying off plan, which is super topical and relevant for investors at the moment as well. Potentially a big opportunity there, but risks that you need to control as well. So reading that, well worth your time as well. Signing up is dead easy. All you've got to do is go to propertyhub.net/magazine.
And a quick note, make sure you are here for next week's episode, because we have the biggest update to Portfolio, our wonderful fintech app that allows you to invest through your phone. That is having a huge update next week, a massive update. And we think it's a bit of a game changer. So make sure you join us for that one.
All right, let's get into our monthly market update. And there's always so much to talk about every month, Rob, when we go through a roundup of what's been happening in the property market and beyond. So really great stuff to get into today. Let's start, as we always do, with house prices, because once again, it's something that everyone's talking about.
It is, and while other markets are really struggling right now, there's no sign of the property market struggling. Growth continues to be there. Not at the pace it has been, it must be said, but it is still there. So according to HomeTrack, over the last 12 months, house price growth has been 8.4%. Over the last 4 weeks versus the 5-year average, demand for homes is up 40%, and the market itself over the last month is up by 0.1%. So over the last 12 months, still very strong. The last month, actually not that strong, but still growth, which seems to be bucking the trend against everything else. It's going to be interesting to see what comes over the next few months. We've talked about the second half of the year being slower than the first half of the year, but not seeing falls. And we talked a lot about that last week, where we did our half-time reports on the year so far and looked to the year ahead. So if you're interested in our view of what's going to happen to property prices for the next 6 months, make sure you check last week's episode out. But Rob, we always like to have a recap of the top performing cities in the UK, and it seems Nottingham has got no intention of dropping its number 1 spot and is seeing double-digit growth for the last 12 months.
Yep, Nottingham continues to do so well. Manchester and Liverpool have been strong performers for years. They're still up there as well. Bournemouth has moved into the number 2 slot, which is interesting as well. That's the first time for a long time that I can remember a city in the south being near the top of that list. But like you said, Rob, prices are still growing, slowing slightly from where they were. And the narrative continues to be that growth will slow. Both Nationwide and Zoopla putting out research in the last month saying that this is what they expect to happen. And that's not surprising for a couple of reasons. Firstly, growth has been so extreme, it's always going to moderate. And secondly, there are, of course, economic reasons why you could see growth slowing down over the next little while. But this kind of idea about how property is going to capitulate at some point, as it's been going on and on and on ever since the pandemic, Initially, of course, when the pandemic became a thing, everyone thought that house prices were going to fall. And then when they didn't, it's just like, oh, well, here's a reason why it hasn't fallen yet, but it will do soon. And it's kind of carried on the whole way through. And Knight Frank has been one of those institutions saying that they believe that property prices will begin to suffer, but they've actually just revised their forecast up. They were saying that price growth over this year was going to be 5%. They're now saying it's going to be 8%. They do, I must point out, revise their forecast quarterly, which is a bit of a bloomin' cheat if you ask me. We do ours annually and hold ourselves to it, and then we have to say if we're right or wrong. It'd be a lot easier if we got to redo it every few months based on what has happened. But in any case, Rob, while I don't disagree that I don't believe that growth will necessarily be as strong as it has been for the first half of the year, I'd say that performance still looks like it's going to be stronger than many or most people predicted. And the consensus view seems to be that growth will continue, just at maybe a slower pace.
Yep, and that's how we see it as well. But like you say, Rob, it would be great if we could revise our predictions every few months. We don't get that privilege, but it seems if you're Knight Frank, you can. And let's see if they're right, They might still get it wrong, but we'll see. An update for you on the story we covered last week on the podcast, which is the Bank of England has withdrawn its mortgage affordability stress tests. Now, at the time, it was all quite raw news and we didn't know what the implications were. Well, we now know that it doesn't apply to buy-to-let mortgages yet. It applies to normal owner-occupier mortgages. Still a move, and still a move to loosening things and forget some of the lessons that we've learned in the past. Not as dramatic as we thought it might have been. Of course, we'll keep an eye on this and we'll bring you a mortgage broker in soon in the next few weeks to give you an update on what's happening in the market right now and give you an update on the products that you should be looking at, because with interest rates going up, of course, a lot of you will want to know what type of product should I be going for. So we'll get a mortgage expert in the next few weeks and give you a full update on that.
So the removal of that stress test is one indication of something that we've seen play out before, which is that when a boom gets going, things get put in place to keep it going and perhaps keep it going for longer than anyone initially expected it could. Of course, as a boom goes on and house prices keep getting higher, especially if they're getting higher relative to wages and everything else, so they're running ahead, which interestingly at the moment they're not. But as that does happen, you need to find some way of making houses more affordable at a higher price. One way of doing that is for mortgage lengths to increase. And right on cue, there's a report in The Guardian that apparently the government is considering a plan for 50-year mortgages that can actually be passed down generations. So we can take out a mortgage and then leave our kids to pay for it. That sounds pretty good to me. Now, at the moment, that is just being rumoured. But if that does happen, then that'll be really interesting, because that'll be yet another factor supporting house prices to get even higher. Something else that's a little indicator of the boom considering is the lender, the Halifax, changing its lending criteria so it will now lend up to 95% on new build houses. Now, this is only one lender, but it's a big one. And previously, they'd only gone up to 90% rather than 95% on new builds because they were concerned that new builds might not hold their value so well. Now, they're going to go to 95% like they do for non-new builds. Which to me, Rob, implies a couple of things. Firstly, that they're not as concerned as they were about new builds holding their value. They're not treating them any differently. But also that they're keen to do business.
Absolutely. All these lenders have had a taste now. The first half of the year was very good for them. Lots of people wanted to borrow money, and they make money when people borrow from them. Now, with interest rates rising, they've had to become more competitive. That's right, but it's not surprising because lenders have had a very good first 6 months of the year. The market was really kicking on and people wanted to borrow from them. And they've had a taste of that now, and they don't want to lose that taste because they like making money, believe it or not. And now interest rates are moving up. People may be a little more hesitant to push forward with borrowing from them for their home or buy-to-let. So this trend of lenders trying to offer different products or loosening their criteria is not a surprise. And it's also not a surprise to see in the Mortgage Strategy website an article on average product fees are falling on mortgages as well. So when you take out a mortgage, a lot of the lenders will charge you a product fee. They are falling across the board. Again, that's a sign that they're trying to become more competitive to draw you in. They're having to up their offering. So no surprises that this is happening, and we will not be surprised to see in future months when we cover the news stories on the podcast that we see more of this. But remember, we'll bring in a mortgage expert soon in the next few weeks who can give us an update on exactly what is happening. So make sure you never miss an episode because we keep you up to date. Just like we will, Rob, in the next 2 weeks, because we have a huge update for all landlords, whether you're one now or an aspiring landlord. The whole PRS market has changed in a dramatic way, yet it's not had any news coverage, or very little, it should be said. Very little indeed. And actually, some of the detail when we got into it even caught me by surprise. I didn't know to the extent of how much our world as investors and landlords is changing. So we've got a very special episode coming up in the next couple of weeks.
Yes, we have. The white paper on that came out a couple of weeks ago and we talked about it briefly on the podcast. We're not rushing to react to it because at the moment this is just a white paper. It's not even going through the first stages of becoming a bill before Parliament yet. So this is not something where you need to know about it right now and go and take any kind of action. So we've taken our time putting together a special episode about this so we can really have absorbed it, got into the detail and reflect on what we believe this means. Because while it's not just around the corner and there's nothing you need to do about it right now, it is going to happen and it is very significant. So do keep an ear out for our special episode about that one coming up soon. Elsewhere in the rental market, the news is that rents are continuing to rise fast. I'm not sure about this data though, Rob. According to the website home.co.uk, average rents over the last year are up by 18.8%. That can't be right. I do not believe that figure, but I do believe that rents are rising fast because I'm seeing that everywhere that I have alerts set up for. So I do believe that rents are going up, but not by that kind of level.
Yes, this article doesn't talk about where they've got the data from for this. So if it's a very small supply of data, then it can be skewed. But what is interesting is it seems to be driven by London more than anywhere else. So rents absolutely are going up across the board in the UK. That is clear to see for anybody who even has a slight interest in the property market. But London seems to be the main driver of this. And then it's no surprise when it links into our next news story that we see this headline. But I must admit, I was surprised because I expected it to be a biggish number, but not this big. But a third of all new homes in London are built to rent. Like, London's a big place, right? And a third of the homes that are being built right now are build to rent. That is huge. We've talked about build to rent before, and now it's becoming a competitor for the everyday investor. And this is really demonstrating that at some level. Although, Rob, before we went on air, you made a great point, which is to say, well, actually, is it skewed because only 7% across the UK is built to rent stock? So really, the vast majority of the stock in the UK that's built to rent is very much London focused right now. But at some point, you'll have ripple effect with build to rent. You know, the value won't be there for the institutions in London, and they will look more and more to other cities. Manchester and Leeds have seen a lot of build to rent already, and I think that trend will only continue.
That's right. It may be skewed by the fact that there's not much in the way of other completions in London, so the figure sounds high. But even if you just take the national figure, 7.2%, it's not nothing. That's not insignificant. It's creeping up. At some point, it's not going to be too long before it gets to 10%, and it's going to start making serious inroads. We've been talking about build to rent for years, and it's kind of happening stealthily, but it's going to start hitting a point soon where it really is a significant force in the market. We actually haven't got this on our list, but Lloyds Bank over the last couple of weeks have announced that they've just gone and bought another 100 new units that they're going to be renting out. And so some of these plans that we've been talking about for the last couple of years, about companies announcing big plans with big sounding numbers, well, they're starting to deliver on those numbers now. That build to rent sector, though, at the moment is focusing on the higher end of the market and is not doing anything for tenants who are on benefits. And there's a story in Landlord Zone about 820,000 private rented households that have got a gap between the level of housing benefit that they receive and the level of rent that they have to pay. And this is not a surprise because the government keeps on freezing the level of housing benefit while, as we've just reported, rents are going up. Therefore, that is going to leave a lot of people with a shortfall, which means either they're going to have to make up the difference themselves from some other source of income, if they have it, or they're going to be building up arrears and may ultimately find themselves out of a home. So it'll be interesting to see what the government does about this. It frequently does freeze the level of housing benefit because it looks unpopular, the fact that the government is indirectly paying money to landlords. So they'll freeze it. Then it does start to cause real negative effects. So it's another story that we'll be keeping an eye on in the months to come.
Some good news now on ground rents. The Leasehold Reform Act has finally gone live after it feels like being talked about forever. And one of the big things to come from that is ground rents are no more. Well, no more for new properties moving forward. They still apply to existing properties. So if you have an existing lease arrangement, then you will be paying ground rent and service charges normally, and that you still will continue to pay ground rent. But if you are to purchase a new property, then ground rent is no more, which is great news. It is really good to see. So it's been a long time coming, but it's great to see it finally here. A step in the right direction, it must be said.
Also, before we move on, a quick mention about EPCs, Energy Performance Certificates. This sounds monstrously boring. It kind of is, but there may be something relevant behind it. There's new guidance to make EPCs more accurate. So this is the first time in 10 years that the way that EPCs are calculated have changed. And it's supposed to make them more accurate. And it does so in some quite important ways. So, for example, electric heating rather than gas heating now gets you a higher EPC rating, whereas previously it didn't. EPCs have been criticised a lot for being not that helpful and also varying massively between two properties that are basically identical, and no one can quite figure out why they're the case. So if they're becoming more accurate, then that's a good thing, because they might be moving towards being an actually useful document rather than just a piece of paper that you need to produce by law. It could be something you could actually do something with. That can only be a good thing.
Now, if you've been frustrated buying a property, say over the last year, for how long the transaction has taken, you're not alone, because actually it seems that it's taking longer for pretty much everyone across the board, because the average time that it takes currently to complete on a property transaction takes 150 days. So that's from sale agreed to completion date. 150 days. That's 50 days longer during the same period in 2019. That's a huge, huge increase. So while it may be frustrating, note that you're not alone, and this just is the state of the world right now, and things are taking longer. But it's important to note that if you haven't put an offer in for a property yet, you want it before Christmas, you better get that offer in soon, because it's roughly 150 days away. Very scary to look at it that way. But yes, that is the case. So there are lots of reasons why this is happening, but mortgages are definitely a big part of this, and how much of a slow process that is. Conveyancing isn't exactly speedy either, but it seems to be most of the clog is around people who are using mortgages, and that's what's slowing things down. Maybe as a cash buyer, you can be more attractive than ever before if you can present the facts that with yourself, it would be a lot quicker than going through somebody who's buying with a mortgage. You can state the data that says that it'll probably take about 150 days.
Okay, we're nearly at the end of this market update, but it wouldn't be a market update without me having a pop at the Bank of England. And so for our final story today, this is one that tickled me a little bit. Andrew Bailey, the governor of the Bank of England, famously, I think it was last month, a couple of months ago, came out and got in a bit of trouble for saying that despite the fact that inflation was really high, people shouldn't be asking for pay increases, because if they did ask for pay increases, then that would actually stoke up inflation further. And he understandably came under some criticism for these comments. Now there's a new story saying that staff at the Bank of England are considering going on strike, demanding a major pay rise, even though their own governor said that people shouldn't be doing this. And even though, if you ask me, the thing that caused the inflation was the Bank of England in the first place. So whether they will go on strike or not, I don't know. If they went on strike, anyone would notice. I also don't know, but I just found that quite funny.
Oh, the irony of it. The governor of the Bank of England suggesting that people should not be asking for pay rises during an inflationary period is just nuts. The market is the market, and you can't control it by making a request. And you'd think the governor of the Bank of England would understand that more than anybody. But hey, that's who's running the show at the moment. Doesn't make him look good, but he's the boss. And some may say it's no surprise that inflation is out of control if he doesn't understand that simple fact. Maybe a bit harsh, but hey, it's a funny story. So that's us done for another week. What do you think? Do let us know on the socials at Property Hub UK. We're there across the board. Let us know what you think of the stories from this week and our thoughts and opinions on them. What are yours? Do get in touch. In the next couple of weeks, we've got some big episodes coming up, so do not miss it. If you've not already, make sure you're subscribed to the podcast, and make sure you spread the word and let other people know as well, because we feel that the type of information we're sharing at the moment is so valuable, and the more people who know and understand what's happening in the world, the better they can navigate it. It's a tough time right now, but if you have education as part of your armory, then you will navigate this world a lot better financially. So we'll be back with Ask Rob and Rob on Tuesday and the main pod on Thursday. So until then, take care, have fun, bye-bye.
Bye-bye.